There's a peculiar pattern in how people approach investing in precious metals, and it reveals something important about the gap between what sounds smart and what actually works. Francis Hunt, a trader with decades of experience analyzing commodity markets, recently issued a warning about silver that most people holding the metal probably don't want to hear. But whether you own silver or not, his analysis exposes a deeper truth about how we think about hedges, store of value, and the difference between an asset that protects wealth and one that just sits there. Let me walk you through what he's saying, why it matters, and what it reveals about the way most people misunderstand the role of precious metals in a portfolio. This isn't about whether silver goes up or down next week. It's about the mental model you use to decide what belongs in your financial life and what doesn't. Before we go further, hit that subscribe button and turn on notifications so you don't miss content like this. And if this changes how you think about your investments, hit the like button. It helps more people find these ideas. Let's start with the core of Hunt's warning, because it's not what you'd expect. He's not saying silver is going to crash to zero or that precious metals are a scam. He's saying that silver, as an investment, operates on a different timeline and logic than most people assume. And if you don't understand that logic, you're likely to make decisions that hurt you financially, even if silver eventually does go up. Here's the issue. Most people buy silver because they believe it's a hedge against inflation or currency devaluation. That's the narrative. The dollar loses value, silver holds its purchasing power, you're protected. And on a long enough timeline, there's some truth to that. But the problem is time frame and opportunity cost. Silver doesn't move in a straight line. It can go years, even decades, without meaningful appreciation. From 1980 to 2010, silver went essentially nowhere. If you bought at the peak in 1980, when silver hit $50 an ounce, you didn't break even for 30 years. 30 years. Think about what else you could have done with that capital over 3 decades. If you'd put the same money into the S&P 500 and reinvested dividends, you'd have multiplied your wealth many times over. But instead, you were sitting on a metal that looked like a safe choice but delivered zero real return. This is what Hunt is warning about. Not that silver is bad, but that it's a bad investment for people who don't understand what they're actually buying. You're not buying a cash flow. You're not buying earnings growth. You're not buying compounding returns. You're buying a static asset that might maybe hold value over time if conditions align, and those conditions are specific. Silver performs well in periods of genuine monetary crisis, geopolitical instability, or systemic inflation that lasts long enough to erode confidence in fiat currencies. But most of the time, those conditions don't exist. Most of the time, the global financial system muddles through. Central banks manage inflation within a tolerable range, and paper assets outperform hard assets. So if you're holding silver as a core part of your portfolio, you're making a bet that the exception will become the rule. And history suggests that's a losing bet for most time periods. Let me give you concrete numbers to illustrate this. Let's say you put $10,000 into silver in the year 2000. By 2011, during the commodity boom, your silver would have been worth around $48,000. That's a great return, nearly 5 times your money. But if you didn't sell in 2011 and you held because you believed the inflation story would keep playing out, your position would have dropped back down. By 2020, that same silver was worth around $17,000. You still doubled your money over 20 years, but you gave back most of your gains. And during that entire period, the S&P 500 went from around 1,400 to 3,700, a gain of over 160% plus dividends. If you'd invested in a simple index fund instead of silver, you'd have turned 10,000 into around 45,000, and you wouldn't have had to time the peak perfectly to capture the return. This is the opportunity cost Hunt is talking about. It's not that silver can't go up. It's that the conditions required for silver to outperform are rare, and while you're waiting for those conditions, your capital is idle. It's not working for you. It's not compounding. It's just sitting there, hoping for a crisis. And that's a terrible way to build wealth unless you're absolutely certain the crisis is coming. Now, let's talk about why people still buy silver despite this logic. Because the narrative is compelling. It feels responsible. It feels like you're being smart and cautious by owning something tangible, something that isn't dependent on the financial system. And there's a psychological comfort in that. You can hold a silver coin in your hand. You can see it, feel it, know it's real. Compare that to a number on a brokerage statement that could disappear if the system fails. The tangibility creates a sense of security that paper assets don't provide. But that sense of security is largely emotional, not rational. Because the truth is, silver is just as dependent on the financial system as anything else. You can't eat silver, you can't burn it for heat, you can't use it to generate income. Its value is entirely based on what someone else is willing to pay for it in the future. And that future buyer is participating in the same financial system you're trying to hedge against. So the idea that silver is independent of the system is an illusion. It's still a market-based asset. subject to supply and demand, sentiment, and speculation. The only difference is that it doesn't generate cash flow while you hold it, and that makes it fundamentally inferior to productive assets over long periods of time. Hunt's warning is really about understanding what you're giving up when you allocate capital to silver. You're giving up yield, you're giving up growth, you're giving up compounding. And in exchange, you're getting optionality in a very specific scenario. A scenario where paper currencies collapse and people flee to hard assets. If that scenario happens, silver will protect you. But if it doesn't happen, you've paid a steep price in foregone returns. So the question becomes, how likely is that scenario, and how much of your portfolio should you allocate to hedging against it? For most people, the answer is much less than they currently hold, because the base case scenario, the most likely outcome, is that the financial system continues to function, inflation remains manageable, and productive assets continue to compound. And in that scenario, holding significant amounts of silver is a drag on your wealth. Let's go deeper into the mechanics of why silver behaves the way it does. Silver is both an industrial metal and a monetary metal, and that dual nature creates volatility that most holders don't fully appreciate. About half of silver demand comes from industrial uses: electronics, solar panels, medical devices, and other technologies. The other half comes from investment demand in jewelry. This means silver's price is influenced by two separate forces: economic growth and fear. When the economy is strong, industrial demand rises and silver goes up. When the economy is weak, but people are scared about inflation or currency risk, investment demand rises and silver goes up. But when the economy is weak and people aren't particularly scared, both sources of demand dry up and silver falls. This creates a boom-bust cycle that's much more volatile than gold, which is primarily a monetary metal with limited industrial use. Gold is simpler. It's a pure fear trade. When people are worried about the system, they buy gold. When they're not, they don't. But silver is caught between two worlds, and that makes it harder to predict and harder to hold through the volatility. Hunt points out that this volatility is fine if you're a trader who can move in and out of positions based on technical signals or macro trends. But if you're a buy and hold investor who's treating silver like a savings account or a long-term inflation hedge, the volatility will shake you out at exactly the wrong time. You'll buy high because everyone's talking about inflation. You'll sell low because the price has been going nowhere for years and you're tired of waiting. And you'll end up with a loss, even if silver eventually goes higher. This is the pattern Hunt has seen play out over and over again in his career. Retail investors pile into silver at the top, convinced they're protecting themselves from an imminent collapse. Then they sit through years of stagnation and decline. Eventually, they capitulate and sell, usually right before the next rally begins. And the cycle repeats. The people who make money in silver are the ones who buy during periods of apathy and sell during periods of mania. But most people do the opposite. They buy during mania and sell during apathy. And that's why silver, despite its theoretical appeal as a hedge, ends up being a wealth destroyer for the average investor. Let me give you a framework for thinking about this more clearly. Every asset in your portfolio should serve a purpose. It should either generate cash flow, appreciate in value, or provide insurance against a specific risk. Stocks generate cash flow through dividends and appreciate through earnings growth. Bonds generate cash flow through interest payments and provide stability. Real estate generates cash flow through rent and appreciates through property value increases. What does silver do? It doesn't generate cash flow. It doesn't appreciate through any fundamental process. Its only value is as insurance against currency collapse or extreme inflation. So the question is, how much insurance do you need? And the answer depends on how likely you think the insured event is. If you think there's a 50% chance that the dollar collapses in the next 10 years, then holding a lot of silver makes sense. But if you think there's a 5% chance, then holding more than 5% of your portfolio in silver is irrational. You're overinsuring against a low probability event and sacrificing returns in the high probability scenario where things muddle through. Hunt's warning is essentially this. Most people are overallocated to silver relative to the actual risk they're hedging. They've let the narrative override the math. They've confused a good story with a good investment, and they're paying for it in opportunity cost. Now let's address the counter-argument, because there is one. Some people will say that the conditions today are different, that central banks have printed trillions of dollars, that debt levels are unsustainable, that inflation is going to spiral out of control, and therefore silver is a rational bet. And look, there's some validity to that argument. The Federal Reserve's balance sheet has exploded over the past 15 years. Government debt in most developed nations is at levels we've never seen in peacetime. Inflation has been higher recently than it was for decades. These are real concerns. But here's the thing. People have been making this exact argument for 40 years. In the 1980s, people said the debt was unsustainable and bought gold and silver. In the 1990s, they said the same thing. In the 2000s, after the financial crisis, they said it again. In the 2010s, after quantitative easing, they said it again. And now in the 2020s, they're still saying it. And during all of that time, what happened? The system didn't collapse. Central banks managed inflation, paper assets compounded, and people who bet heavily on precious metals underperformed people who stayed invested in stocks and real estate. This doesn't mean the collapse will never happen. It just means that betting your financial future on it happening soon is a gamble, not a hedge. And the longer you wait for the collapse, the more you pay an opportunity cost. So Hunt's advice is to treat silver for what it is: a small allocation, a tail risk hedge, something you own in case things go really wrong, but not something you build your wealth around. Maybe 5% of your portfolio, maybe 10 if you're particularly concerned, but not 30, not 50, and certainly not 100%. Because if you're wrong about the collapse, you've destroyed your financial future. And if you're right, you'll probably have bigger problems than your investment returns. Let's talk about liquidity, because this is another dimension Hunt emphasizes. Silver is less liquid than most people think. Yes, you can sell it, but the spread between buy and sell prices is significant, especially for physical silver. If you buy silver coins from a dealer, you might pay 3 or 4% over spot price. When you sell them back, you'll get spot price or slightly below. So right away, you've lost 6 to 8% in transaction costs. Compare that to selling a stock, where the bid-ask spread is a fraction of a percent, or selling a bond, where you can often get close to fair value. Silver is expensive to trade, especially in small quantities. And if you need to sell quickly, you're at the mercy of whoever's buying. This is the opposite of optionality. Optionality means having choices, having flexibility, being able to move when you need to. But silver, especially physical silver, locks you into a position that's hard to exit without friction. And that friction compounds over time. Every time you rebalance, every time you need cash, every time you want to adjust your allocation, you're paying those transaction costs. Over a lifetime, those costs can add up to a significant drag on returns. Hunt's point is that for most people, the liquidity and transaction costs of holding physical silver outweigh the theoretical benefits. You'd be better off with a diversified portfolio of stocks and bonds, with maybe a small position in a silver ETF if you really want exposure. Because the ETF gives you liquidity without the friction. You can buy and sell instantly at transparent prices with minimal spreads. You don't have to store it, insure it, or worry about theft. And you can adjust your position as conditions change without paying a dealer's markup. But even then, the fundamental issue remains. Silver doesn't compound. It's a static asset in a world where compounding is the primary driver of wealth creation. And that makes it a poor choice for building long-term financial security. Let me take this in a slightly different direction and talk about the psychology of holding silver, because this is where a lot of people get stuck. Owning silver feels like you're doing something. It feels like you're taking action, being prepared, protecting yourself. And in a world where so much feels uncertain and out of control, that sense of agency is valuable. But the problem is that feeling prepared and actually being prepared are not the same thing. You can own a lot of silver and still be financially vulnerable if you don't have adequate income, savings, or diversification. In fact, owning too much silver can make you more vulnerable, not less, because you've tied up capital in an asset that doesn't generate returns. Think about it this way. If you have $50,000 and you put it all in silver, you feel protected against currency collapse, but you're completely exposed to every other risk. If you lose your job, you have to sell silver to pay bills, possibly at a loss. If you need money for an emergency, you have to liquidate. If the price of silver drops, you're stuck waiting for it to recover. You've concentrated your risk instead of diversifying it. Now compare that to someone who takes that same $50,000 and allocates it differently. $10,000 in an emergency fund, $30,000 in a diversified portfolio of stocks and bonds, $5,000 in silver as a tail risk hedge, $5,000 in a high-yield savings account for short-term flexibility. That person is far more prepared for the range of scenarios that might actually happen. They can handle a job loss. They can handle an emergency. They can handle a market downturn. And they can handle a currency crisis. They've built resilience across multiple dimensions, not just one. This is the insight Hunt is trying to get across. Resilience isn't about owning one magic asset that protects you from everything. It's about building a portfolio that works in most scenarios and doesn't blow up in any of them. And silver, as a concentrated position, violates that principle. It protects you from one specific scenario while exposing you to many others. So if you're holding silver, ask yourself, am I building resilience? Or am I just making myself feel better about a fear I can't control? Because those are very different things, and they lead to very different outcomes. Let's talk about what Hunt actually recommends, because it's not that you should never own silver. It's that you should own it in proportion to the risk you're hedging and the opportunity cost you're paying. If you have $1 million portfolio and you want to hedge against extreme inflation or currency risk, putting $50,000 into silver or gold might make sense. That's 5% of your wealth. It won't destroy your returns if you're wrong, and it provides meaningful protection if you're right. But if you have $100,000 and you put $50,000 into silver, you've just bet half your wealth on a single scenario. And that's speculation, not hedging. Hedging is about reducing risk, not concentrating it. Speculation is about making a directional bet and hoping you're right. Most people who own a lot of silver think they're hedging, but they're actually speculating. And they're doing it with an asset that has a terrible track record of delivering consistent returns. Hunt's framework is simple. Own productive assets first, then add hedges in small amounts. Your foundation should be things that generate cash flow and compound over time. Stocks, bonds, real estate, businesses. These are the engines of wealth creation. Once you have that foundation, you can layer in hedges for specific risks, a little gold or silver for currency risk, some inflation-protected bonds for inflation risk, some cash for liquidity risk. But the hedges are the garnish, not the meal. They're there to smooth out the ride, not to be the primary driver of returns. And if you flip that around, if you make the hedges your foundation and treat productive assets as optional, you're almost guaranteed to underperform over time, because you've optimized for the exception instead of the rule, and in investing, the rule almost always wins. Here's another angle that Hunt emphasizes: the difference between nominal returns and real returns. Silver might go up in dollar terms during an inflationary period, but if inflation is running at 8% and silver goes up 10%, your real return is only 2%. You've barely beaten inflation. Meanwhile, stocks might go up 15% during the same period, giving you a 7% real return. So even in the scenario where silver is supposed to shine, it often underperforms equities, because equities represent ownership in businesses, and businesses can raise prices to offset inflation. Their revenues go up with inflation, and over time, their earnings and stock prices follow. Silver doesn't have that mechanism. It's a static asset that only reflects fear and speculation. It doesn't adapt, it doesn't grow, it doesn't compound. And that structural disadvantage means it's almost always going to lag productive assets over the long term. Hunt has run the numbers on this over multiple decades and multiple cycles, and the result is always the same. Productive assets win. Hard assets like silver provide temporary relief during crises, but they don't build wealth. And if your goal is to build wealth, not just preserve it, then silver is the wrong tool. Now, I want to address one more thing before we wrap up, because it's important. Some people own silver for reasons that have nothing to do with investment returns. They own it because they believe the financial system is fundamentally corrupt, and they want to opt out. They own it because they like the idea of holding something physical that's not tracked or controlled. They own it because it aligns with their worldview or their values. And if that's you, if you own silver for philosophical reasons rather than financial ones, then Hunt's warning doesn't really apply. You're not trying to optimize returns. You're trying to live according to a principle. And that's a valid choice as long as you understand the trade-offs. But if you own silver because you think it's going to make you wealthy or because you think it's a smart financial move, then you need to reconsider. Because the evidence doesn't support that belief. The math doesn't support it. The historical data doesn't support it. And the people who've built real wealth, the people who've compounded capital over decades, aren't doing it with silver. They're doing it with businesses, real estate, equities, and other productive assets. Silver is a footnote in their portfolios, not a chapter. And that tells you everything you need to know about its role in a wealth-building strategy. Let me bring this full circle. Francis Hunt's warning about silver isn't about predicting the price. It's about helping people understand what they're actually buying when they allocate capital to a non-productive asset. You're not buying growth. You're not buying cash flow. You're not buying compounding. You're buying insurance against a specific scenario. And like all insurance, you should only buy as much as you need, not as much as you can. Because overinsurance is just another form of waste. It's capital that could be working for you, sitting idle instead. And in a world where time is your most valuable resource and compounding is the most powerful force in finance, wasting capital is the same as wasting time. You can't get it back. So the question you need to ask yourself is this: what percentage of my portfolio is actually working for me? And what percentage is just sitting there, waiting for a crisis that might never come? If the answer is that too much is sitting idle, then it's time to rebalance. Not in a panic, not all at once, but deliberately and thoughtfully. Shift capital from static assets to productive ones. Reduce your exposure to speculation and increase your exposure to compounding. Build a portfolio that works in the scenarios that are likely, not just the scenarios that are scary, because that's how you build real financial security. Not by betting on disaster, but by positioning yourself to thrive in normal conditions, while having enough protection to survive abnormal ones. That's the balance Hunt is advocating for. And it's a balance most people holding silver have lost. Before we close, make sure you're subscribed to this channel and hit the bell icon so you get notified when we drop new content. And if this video made you rethink your approach to precious metals, hit that like button. It really does help. The takeaway here isn't that silver is evil or that precious metals have no place in a portfolio. The takeaway is that most people misunderstand what they're buying and why they're buying it. They've bought into a narrative without doing the math. And the math is clear. Over time, productive assets outperform static ones by a wide margin. If you want to build wealth, own things that grow. If you want to hedge risk, own a little insurance. But don't confuse the two. And don't let fear drive your allocation decisions. Because fear is a terrible investment advisor. It pushes you towards safety at exactly the moment you should be positioning for opportunity. And it keeps you locked in defensive positions long after the threat has passed. Hunt's warning is about breaking that cycle, about recognizing when you're holding something out of fear rather than logic, and about having the discipline to adjust your portfolio based on evidence, not emotion. That's the mindset that builds wealth over decades. Not predicting the next crisis, but building a system that works regardless of what happens next. And that system starts with understanding what each asset in your portfolio actually does and whether it's earning its place. Silver, for most people, isn't earning its place. And the sooner you recognize that, the sooner you can deploy that capital into something that actually moves the needle on your long-term freedom.